Hi, this is David Duty again with Common Sense Options. We're on lesson number 37, CYA, which represents not what you probably think that it does, but it represents cover your assets. And we're going to look at putting on a bullish or a bearish trade. I won't get into all the reasons why, but I'd want to get short this market. MACD is going down, slow stochastics, and some other stuff that I looked at. So I'd want to get short this market. So I'm going to be placing an order to sell one just under the lows of today. And as for protection, I'm going to buy a put or a call at about the same price. And to help offset the cost of that, I'm going to sell a call up here. So to figure out how much risk that we've got on here, we picked up 856. Let's get our calculator. That's going to be a credit. All right. So we're going to subtract 1381 minus 856. So we picked up $525 in, or shorted or made up for $525 in the cost of the call that we sold. We offset that by 500 bucks, okay? So hopefully the market will continue to go down. And if it does, then we're going to look at doing some other things to increase and protect our profits. Well, okay, we're up $75. Now, if anybody's been watching corn, it's been really volatile. All right, see the big gaps in here in the last few weeks? So that's one of the reasons that I think that it's time for a pullback, and I wanted to go short. So keep an eye on our account. We're up $275, nothing major, but let's see what happens, okay? And also keep an eye on your MACD and your slow stochastics. All right. Big gap down. Put us ahead almost $2,000 on that trade. All right. All right. We have a few things that we could do. We could leave this call up here. Hopefully that it will expire worthless. We could get out of the call that we purchased. That's worth $562. And then we could put a protected future stop down in here. Let's do that. So on the call that we sold, we're going to leave it alone. On the call that we purchased, we're going to sell one, and we'll be flat on that call. And then we're going to take a protected futures contract. Oops. And we're going to bring our stop just above here and buy it back. And I want to explain to you why that's where I would put my stop. The reason being, when you see a gap like this, or it gaps down, on the opposite side of that gap, prices will tend to stop before. You'll hear the term gaps fill. Well, in candlestick charts, they call this a window. And that window is open right now. And if it fills, if that gap does fill, they'll say that window is closed. But it's a good place to put your protective stop. So let's play it forward, see what happens. We're up 1768. All right, I'd be moving this protective stop down here. Somewhere above here, get a little bit of room. And you're up $3,000 on that trade. Okay. This is going to expire worthless, it looks like. I'd leave my stop alone. Well, you're up 4,400. No, I'd move that stop down. I'd take a lot of that. I'd protect a lot of that if possible. All right, I'm going to move that stop down. We got stopped out. So we picked up $3,312 on that trade. Now let's see what happens. This call that we sold up here is only worth $275. So I'd leave that alone. And let's see which way the market goes. If it continues down, we might do something, bearish. And if the market reverses, it's going to have to break through these windows here. Let's see what happens. Wow, what a day. Not only did it break through the first window, it broke through the second window. That's a big day for the bulls. All right, so we did okay. We locked in $3,200 in profits on that trade. But what do we do now? The only position that we have on is this short call, the one that we sold up here. Let's see. Well, we could sell some puts. I don't know if I'd want to buy some call or sell some calls. Well, let's do this. Let's sell a call up here for $256. Wait a second. Let's not do that. Let's do this. We're short a call, so if that price continues to go back up, we're going to lose money on that. Why don't we offset some of that by selling a put? Let's sell a put down here, 362. So we're going to sell this put. So if the price does rally, this call that we've got up here is going to go up in value. And if the price goes down, then this put that we sold down here is going to go up in value. But hopefully what will happen is that we picked up some premium and that the price will close somewhere between here. Okay, and if it closes anywhere within this area, then we pick up all the premium from the call and the put that we sold. So let's see what happens. We're up 13. We're up 3,300 on the trade. Things seem to be working. Big day. Came back down. We're up 3,200. Wow, look at this. Well, this put that we sold is worthless. We're still up 3,000 on that trade. Geez, what to do? What to do? Well, calls further out. Risky, but I'm going to try it. All right, we're at 3,000, 3,200, 3,200. If the market, all right, the market's headed maybe back down, and that's what we want. Uh-oh, back up. We're still at 3,100 on the trade. Now we're at 3,800. Hopefully that market will come back down and close down in this area, and we'll pick up all the premium. 3,900, 4,100, 41, 4,200. We picked up 42. Oops, let me play it back. All right, we're getting out the next day. We're going to buy that one. We're going to buy that one. Actually, they would just expire, but this put down in here, we're going to buy that. So we'll be flat the market. All right, we picked up $4,000 on that trade. And that's a trade that just went absolutely crazy. All right, and if you recall what we did, we shorted the market here. We used a put for protection. We sold a call to pick up some of the risk on the, or the cost on the call that we used as a protective stop. When the market went down in our favor, we liquidated our protective stop up here, the call that we were using for protective stop. We brought our stops down, got stopped out, or we set a stop and got stopped out. And then we played around with the market using some other call strategies. But overall, it was a good trade. We picked up $4,000 in corn on the May 11th, or the May 2011 contract. All right. We're going to look at some other kinds of trades and what to do and how to protect yourself a little bit. Hope you enjoyed that one.